Hello, everyone, and welcome to our Yardi Matrix Self-Storage National Outlook on March 24th, 2021. My name is Megan Furr, your producer for today's program. We are joined today by our hosts, Jeff Adler and Jack Kern. Our program will run about an hour, and we hope you can stay with us for the entire broadcast. We want this to be an interactive conversation, so please feel free to submit questions in the Q&A icon at the bottom of your screen, and we will try to respond to your messages while covering relevant topics. If we don't get to you, please contact us afterward for a more detailed answer. A recording of this broadcast and accompanying slides will be available after the program. Please note that what we discuss today may or may not be relevant to our situation. Please read the disclaimer carefully and consult your tax and investment advisors before making any decisions. Now, I am pleased to welcome Jack Kern, Director of Research and Publications, and Jeff Adler, Vice President of Yardi Matrix, to our program today.
Thank you, Megan. Hi, everybody. I'm going to probably put myself back on non-video. Thank you for joining us today. Chris Niebenzal is on parental leave, and so I know many of you know him. He won't be able to join us. Feel free to wish him well. So he's taking us some time with family. What we're going to cover today is, in addition to, I would say, our normal discussion around supply analysis, two new topics that we really wanted to introduce. One is looking at storage versus other asset types from an investment thesis standpoint, and then working through the continued migration trends and how that is fueling acquisition interest, not only development interest in self-storage. And so we'll have a discussion around that. As usual, let's just kind of go into what we see as the answers. Then we'll kind of walk you through how we got there. First of all, the economy is poised for very strong growth in 2021. We will be watching and discussing concerns of inflation and therefore also potential rising interest rates that affect cost of funds. Demand trends that rose in 2020 really did provide a huge tailwind for self-storage fundamentals, as well as values, as well as institutional investor interest in storage. And we think that not all of that will be durable. However, it'll probably dissipate over probably 2-ish years, and we'll kind of get to that. But there's a potential, I think, for a second wave of moves, as we saw in some consumer research, which may make this much more of a soft landing or to be able to sustain some of these demand trends. Street rents have been rising nationwide. There's really been no major slowdown in supply. And as we get to the rising nationwide street rents, we'll also actually have a new category of kind of plus fives, which we didn't have before. So that's kind of good news. Institutional investors who are trying to deploy large amounts of capital are using acquisitions as the way to do that, reinvigorating an acquisition market where most investment in the past several years had been through development. 2020, not surprised, saw over the course of the year slowed in transactions, but really picked up in December. We think in terms of demand tailwinds, there will be movement as people kind of get more permanent or come back to the core cities, as well as sort of make their moves more permanent. So we think that over the next 18 to 24 months, absent a second wave of work from home generated moves, that demand will dissipate, but slowly, so that we're able to sort of absorb that. And I think the supply trends, if this is true, and rents continue to sort of be reasonably on a positive note over the next couple of years, it seems to me like supply will continue, in terms of the new supply, will continue to be delivered. And so we're overall, I would say, cautiously optimistic. We're constructive on the sector, constructive on the ability to do existing customer rent increases, which will kind of buoy overall NOI in the industry. And there's a move, obviously, to reducing and automating the entire rental experience, which will reduce expenses. So I'm cautiously optimistic, but I wouldn't say wildly optimistic about the sector. Let's take a quick kind of look at the economy. Look at the Atlanta GDP now numbers, 5.7%. And you can see even just in March, as the pace of vaccination picks up, as the pace of economic growth picks up, and with the level of stimulus, both monetary and fiscal, we're going to have a pretty much of a gangbuster kind of year. coming out of this. And so when you look at anything, and I love Ed Hyman's work at Evercore. In 2021, you look at a very strong kind of bounce back, and then kind of a still 3% in 2022 is very strong growth, but a beginning of an uptick in inflation, beginning of an uptick in 10-year bond yields. I think we're at the 1.7 now. We could easily be at 2 without too much surprise. And 2.5 in 2022 doesn't seem crazy to me at all. And was it driven by fiscal and monetary stimulus, reopening, economic momentum? There's a lot of dry powder among U.S. consumers on inventory rebuilding. So bottom line is, I think we're set for, I'll call it a shot out of the cannon pretty strongly in 2021.
Something you might want to also talk about briefly is
Sure.
the impact that growth in GDP has with inflation.
Well, I'd say is that you have so much monetary and fiscal stimulus kind of moving things forward. As growth continues, interest rates have been steeply negative. So just a return to not being negative and inflation, and we'll kind of get to this kind of in the second quarter, you'll see a bounce that will be sort of kind of talked away. I think the issue in my mind is more 6 months from now. Will the supply constraints on the goods sector kind of dissipate? Will services inflation kind of recover? And so it's not hard to believe that you get back to 2% inflation. And now you're talking about if 2%, if inflation's 2% and the 10-year is 2.5, that's still a very low real rate of interest. And I think that's more of that's going to be a bigger economic question, is the playoff between the use of the savings that's been built up for most of the people in the economy. There's 10% have been kind of hurt. The rest of the 90%, it looks a version of the Roaring 20s, I gotta tell you. But you can see where economic growth forecasts have been increasing over the past several months. And onto the right, you can kind of see that with the fiscal and monetary stimulus you've got, you're probably back on trend. The question is, in all of these things, will the Fed and everyone else around here in the government miss the signal that they could be overshooting? And that's going to be, in my mind, a little bit of a walk. We're going to have to be very careful about. Go back here. If you look at the financial markets, you can kind of see the yield curve now kind of from a year ago, positive. The stock market and equity markets have been kind of rebounding. There's going to be some rotation between tech names and names that really were hurt due to COVID, and they're kind of bouncing back as the economy opens up. But if you look at the 10-year note, 1.7 is crazy. It's really a recovery off of very, very low rates. Even getting back to 2 just takes us back to where things were in 19, much less where we were in 18 at 3%. And internationally, the U.S. Yields on the 10-year are high relative to other developed markets, which means we continue to be a place to attract capital from overseas. So, and in all manner of investment classes. One of the chief interesting things that are observations is if you go back 20 years or even further, there have been a movement of a shift of consumer spending away from goods and towards experiences and services. COVID has sort of flipped the script on that, and the spending on goods has been extremely high, and much more because you couldn't really spend money on services. There will be some movement back, from this, but the investments made in people's homes and the need for space, those investments are long lasting and will tend to sort of carry on. But we should expect to see a flipping, right, of spending back towards services as 21 and 22 proceed. However, remember, goods consumption usually means that there's a spillover of goods that have to be stored, which is very positive for storage. So kind of going through that, you can look at the change in monthly retail sales, sporting goods, building materials, parts, furnitures. These are stuff that sort of, again, are personal assets that tend to need to be stored and create demand for storage. So this tends to be a bit of a tailwind for storage. When we look at oil prices back, it's over 60, near 60 bucks a barrel and over 60 bucks a barrel. That is a potential for inflation, but the sort of countervailing effort is that the U.S. crude oil industry is really, because it becomes a swing producer, is really the way that I don't think we're going to get back to 100 buck a barrel oil unless inflation gets completely out of hand. And I think U.S. producers, Jack, and you're maybe more the expert on this, rig count has hooked up, and most of the U.S. oil industry can do it. It can be profitable at 60 bucks a barrel. What
Yeah,
do you see in terms of that?
yeah, the rig count's up to 478 as of March 17, which is up a little bit. It's about 5.5% since last month, but it's still down 41% on a year-over-year basis. As of today, West Texas Intermediate is $61 a barrel and Brent crude is 64. So it's right in the range of what would be acceptable for most oil companies.
Yeah, so I think what means is that we have a vibrant or resurgent U.S. oil industry, which will be a tamp on any kind of runaway kind of goods inflation. And I think the goods inflation we're seeing now are more supply bottlenecks that are very relevant, but not necessarily sustaining. Again, one of the things we've been talking about is that, again, we've always had services inflation, and it was offset by goods deflation. And now we've seen services deflation with goods, some emerging goods inflation, but not that bad. We'll see it flip. There'll be goods inflation. We'll get to a 2% ish, 2.5% inflation. But I think the composition will rebalance back to services inflation and goods deflation again, particularly with China policy reopening up the Chinese importation of physical goods. So I think we're kind of back to where we were. Again, you can see here, this is the spread between the 10-year Treasury and the 10-year TIPS. It's approaching 2, but it's not really a long-term issue. But again, go back to 04, 05, the spread was 2.5 points. So this isn't out of control yet. Not that it couldn't be, but it's not out of line yet. But consumer inflation expectations are up over 3, and that's because the stuff that people can buy costs more. On a CPI basis, you have a blending of different goods and services, some of which you can't really buy. So that's tamping down the official rate, at that under 2% level. Unemployment, underemployment is falling. It's still elevated. I think we've talked about where the path to the end of 2022 kind of gets us to. I don't think that's crazy compared to where we were entering COVID in January and February of 2020. So I think that's very positive. It will create, again, if this moves forward, labor shortages and labor price pressures. One of the things we kind of see is that storage is highly impacted by population dislocations and the movement of people. And this really just looks at the geographic spread of unemployment, heavily concentrated in localities that really kind of crushed their service sectors or heavily based on tourism, less so in other places. Florida actually among tourist locations has done pretty well. When we look at population growth, and this is the movement of any states that either had a lot of people leave or a lot of people come, has been very positive for storage. So Florida, Texas, Idaho, Utah, Nevada, Arizona, even Colorado, all migration out of California. So the people leaving, if they were temporary out of California, created demand for storage. The people coming created demand for storage. And so this is probably the upside and has shown the resiliency of the sector and why it has attracted so much institutional investor interest. When you look at the labor market, and this is kind of a big, this has been said before, but it is kind of a big deal, right? Folks who are have higher levels of education, they're involved in information industries that don't require person-to-person contact, their employment, both employment level and wage level, has done extremely well, taking very, very small hits. The folks who have required, who are lower wage earners, they've taken a big hit, and that's where the pain has been concentrated. Now, what that means, I would say, is that means is for people who have goods, they also tend to have income to store those goods. So I don't see that being too much of a problem for storage. Current U.S. federal policies really are, in my mind, largely a return to the 40-year previous consensus, for good or for bad, on favoring urban and suburban consumers over producers, both in terms of farm economy and manufacturing and extraction industries. So the elements that are pro-growth, and I did something similar to this right after the election in 2016 and early 2017. So I've used the same structure. Low interest rates for longer, at least on the short end, are very much pro-growth. As the yield curve picks up, it's profitable for banks to lend. Fiscal policy certainly is supportive. Will it be too much? That is an open question. Certainly, if you're getting the next round of blowout spending, it could be. The vaccination being ramp up certainly are pro-growth. There is a potential for inflation we're going to watch closely. It is offset potentially by the aging population, which saves more. We see that in the savings rate, and deflationary technology. So it's not clear that you have sort of a runaway inflation scenario, though this does look similar to the 1920s and the 1960s. So the only difference would be the level of an aging of the population, which saves more. There's a whole bunch of things that are, I'll call it, ambiguous and unclear. I've listed those. We'll see how those kind of play out. And there are some anti-growth elements in the policy mix, executive orders on energy, oil and gas, and finance and tech, and also the inability to open the schools is a big deal, which really has to kind of be broken through and may add to migration flows. So this $1.9 trillion stimulus bill, it always helps to know where the money is going. The bottom line is when it comes to stimulus checks, most of the money is going to people who don't need it. And so it's really kind of free money that will be either saved or spent. The unemployment benefits will probably extend the period of which employment recovers. But the way it's kind of set up, it's not that bad. It's through the end of August as the vaccination ramps up and businesses open up. It's probably okay. The key thing would be to make sure it does not get extended. There's a pile of money for state and local governments, not tied to their expenditures, not tied to reductions in their actual tax receipts. So a lot of that is honestly political payoff for the Democratic constituencies, as well as the school support money, as well as the multi-employer pension plan. So I would tell you that most of this money is basically redistribution and political payoff and payback to the administration's constituencies, and some money that will actually probably help in the recovery. But a lot of it's going to show up in redistribution. So what do I think in terms of prognosis for 2021? While the recovery is not universal, it is varying based on metro and level of income, but what we're coming out of it pretty strong. Employment will tend to lag GDP growth, and pandemics tend to have a long-term impact, particularly on birth rates. But I think we will get back to full employment at the end of 2022. We'll be watching very closely rising inflation rates and migration. But multifamily seems to be holding up well. And what I would tell you on storage is doing phenomenally well. So I'm certainly not concerned about that. So let's talk about one of the things I wanted to cover here is how does storage stack up from the perspective of an institutional investor looking at real estate as a set of asset classes. How do they look at self-storage relative to other asset classes, and how are they allocating between those different types? So first of all, understand that if institutional investors are increasing their allocation to real estate in general, up from maybe 8% to 12 to 15%, much of which is not being able to be deployed. And then when you look inside of that, you can see self-storage in 2020 did incredibly well. Had not done that well, relatively speaking, 2016 to 2018, more due to supply pressures. And while 2019 was a good year, didn't do that well on a relative basis. But 2020 really demonstrated self-storage's position. And if you look at this, and this is some data that we got from MSI and PRIA, and looking at different kind of core diversified open-ended funds and all open-ended funds, you can see both in at the end of 2020, right, great performance in 1 year and really good performance over 5 and 10 year periods of time. And when you look at these kinds of returns over this kind of extended period of time, an institutional investor says, wow, relative to industrial, which is very, very pricey, very low cap rates, and other asset classes, self-storage as a niche investment class is very attractive. And that's what, in my mind, is driving a lot of the institutional investor interest. When we look at just some comments from the earnings calls, average store occupancies are 92 to 95, which is up maybe 2 to 300 basis points, while supply is a bit of a new concern. We'll cover that in our own data. It's there, but it's not been an impediment. Street rates are growing nicely. The storage REITs are expanding their third-party property management platforms, and the fact of the matter is the industry has excelled. It's done well. If you look at across all asset classes, data centers, industrial, and storage are the standout performers among all asset classes. And so one of the things that we kind of pulled together here was just to compare from an index basis the REIT reported, realized rent per occupied square foot, which is both new and existing customer increases, compared to Matrix on a 10 by 10 basis, which really is tracking new rents. And so you can see that, and I would kind of focus the pandemic issues. Second quarter of 2020, the movement has been the same, right? So the REITs have kind of outperformed under supply pressure due to, I think, existing customer rent increases. And we see a decline in street rents. And then in 2020, as the pandemic hit, significant movement in new street rents and also obviously in REIT occupancy. So what do you walk away from that? Boy, to an outside investor, not someone who's dedicated to the self-storage industry or has a career in the self-storage industry, but from a kind of a 30,000 or 50,000 foot level, storage looks very, very attractive. And at the beginning of the pandemic, there were a number of institutional investors who ran away from the sector and ducked and covered. Those who did that probably have come to regret it because they missed an opportunity. And there is a lot of money that is wanting to be deployed into self-storage. So let's take a look at how this migration has kind of panned itself out. So first, just to kind of note, our storage market classifications, we have about 31 major markets, both primary and quote unquote primary and secondary. And then we have a group of quote unquote we call tertiary markets, which are still meaningful markets of size, but they are a bit smaller. And we, for the sake of argument here, we track those a little bit differently in the data that we're going to present to you. As may have mentioned earlier, COVID was really, I would say, largely an accelerant of trends that were already there. So you can look at these trends of people moving from gateways, declining birth rates, people living longer at home, virtualization, the digitization of experiences, e-commerce, local political risk, and higher property taxes. All these trends were already there. They've been accelerated. The aging of the population really creating new renters, and in this case for storage, as the population ages, there's still more material goods, so that's a slight positive. The three reversals, experience over things, densification, and globalization, those have reversed. There were elements of those being reversed or before COVID, but again, they've been accelerated. Now, when you look at migration, these are the migration patterns. You saw that earlier in the chart around where population was declining and where population was increasing. This is more of a graphic, and if I was looking at California, I would probably tell you that it was also Nevada and Idaho, Utah, as well as Colorado, Arizona, and Texas. And then from the Northeast down to the Carolinas and into Florida have been the main sort of migration corridors. These corridors already existed. Again, they've been accelerated due to COVID. You can see the same when we talk about the population, kind of just a reprise of the same trends. Now, within that, in addition to movement across metropolitan areas, there's been a substantial movement outside of urban cores and into the surrounding communities around those urban cores. So Chicago, Los Angeles, and then this is from Postal Service record data. It's pretty clear that we've also had some survey data along these same lines. And this is just an example of local moves, right, out of Manhattan and into sort of the surrounding areas, as well as out of San Francisco into the surrounding areas, right? Again, 30, 40 miles is still meaningful from a local market perspective, but not leaving the metropolitan area. And this is very much tied to work from home or sort of work from distance, and even an expectation, which I think will continue, of the ability to move across distances. And one of the things we talk about here is let's talk first of all. Bank of America reported card spending for storage was up 19% year over year. So that's kind of exciting. COVID-related disruptions, people moving, needing space, that's boosted storage demand. And that, what we kind of said, is likely to somewhat dissipate. There is a potential for a second wave, as now, and this is something everyone really should kind of be tied into, as employment and employers begin to sort of make more permanent this notion of, well, maybe 3 days a week, and maybe more people and more teams don't necessarily have to come back to the office. You could see, and some of the consumer survey data has indicated, that there could be a second wave of moves from higher cost markets into lower cost markets, which would tend to keep the level of demand more stable at its current levels. You'll still have new supply coming in, so there's still kind of pressure. But what I would tell you is that certainly over the next 2 years, the demand will be there. It will probably slowly dissipate. It may be reinvigorated by a second wave of moves to lower market, lower cost areas. And so I would say cautiously optimistic that this will kind of hang in there, but new supply will continue to weigh on results. And if you take a look at this is just a notion of the movement, a rather meaningful change in occupancy that was reported by the public REITs across a number of these major markets, +1 to plus 4%. Again, Riverside really sort of an out-migration from the LA area. Now, this is something that, if we look back a year or two ago, most of the markets were red or yellow. We actually had to create, as I said before, a new category of blue, because 5% street rent growth or higher in Inland Empire and San Diego, Miami, and San Francisco and the Bay Area. This is really, really quite positive, even in places where you have high penetration and high supply, like Vegas or Sacramento, even Orlando. A lot of supply coming, and yet street rents have been very positive. And even if we look at some smaller markets or non-major markets, you also have really good operating results. You don't nearly have the same level of development pipelines yet, but a place like Boise or Reno, very, very high penetration, high supply, and yet high rent growth. Those markets may not stick around. Oh, by the way, I do want to kind of mention the normal tables that we provide, which actually give you the numbers behind this. In the interest of time, they are in an appendix, and you can kind of see the actual numbers behind these charts in the appendix. When we also, again, this is another measure of the resiliency, because we also track multifamily as well as storage. We can kind of do a little bit of a compare and contrast, right? Where San Francisco, as an example, storage rents went up as multifamily rents went down 20%. So on the one corner case where rents are, in multifamily declining, storage rents going up. But even in places where multifamily rents were going up, storage rents went up too. So that's, very encouraging. You look at Miami or Dallas or Phoenix, right? And there, while it may not be has grown as quickly as multifamily rents, this really talks to the resiliency of storage, that as long as there's movement of people, storage tends to do quite well, and that certainly this has borne itself out. Now, having taken that kind of knowledge, right, then you kind of say, okay, well, institutional investors are looking at these trends and these results and saying, wow, we want to deploy capital into storage. Development tends to take time to deploy that capital and get a return on it. Acquisitions is much quicker, and that's where a lot of the activity has been over the last 6 to 9 months, and I suspect that it will be even more so in 2021. You can kind of see all of these major transactions, a lot of capital being deployed. I know of several other platforms that are deploying capital, and they're doing so through taking out large portfolios in order to make this happen. So this is something we definitely see happening. And if you look at this in terms of pricing, pricing per square foot is most definitely up. Again, total transaction volume down in 2020, but I expect that to pick up meaningfully in 2021, even though January and February, as recorded in 2021, are a bit slow. We also took a look at this and kind of broke it apart, looking at Class A, Class B, and Class C assets, and certainly from a pricing standpoint, like looking pretty darn good, from these roads, and kind of in a very sort of interesting way, the Class C movement on a relative basis is dramatic. These are old assets that, while they're cash flowing, they really are not well positioned for future enhancement, maybe scrape and build opportunities, or maybe expansion opportunities, and that's kind of what's driving the price per square foot, the optionality. Because as I mentioned before here, we saw a spike in transactions in December, a year end, a bit of a fallback in January, but again, I don't really expect that to sort of be here long term. We have looked at urban versus suburban, and you can kind of see that a lot of the transaction activity in December was suburban assets. It makes a lot of sense. You're following the population, which is, if you look at our multifamily webinars, you can see the movement of population into suburban areas, whether they are in the core markets or in sort of the tech hubs. The suburbs have done better than the urban areas, and so it follows through the storage. If you look at in terms of market activity, look at some of these major markets and the amount of transactions. Now, all in all, though, 19 or 20 sales isn't a tremendous amount of activity relative to storage. It is relative to other asset classes. It's not. But Tampa, West Houston, Austin, Atlanta, Phoenix, these are, McAllen kind of surprised me. But Nashville and Memphis, Kansas City, these are, a lot of activity going on in these markets. And on a percentage basis, this can be, I'll call it, a tad misleading. It tends to be volatile. But I would just kind of more focus on that there was a lot of activity in some of the smaller northeastern markets that were more suburbanish in nature, and the ones that are negative, you just could have the absence of a transaction, and that could make some of these numbers kind of move quite quickly. As we kind of mentioned before, institutional investors, a driving force transactions in 2020. Look through the list of the major players and what they bought. Again, very much an indication of an influx of institutional capital, and the sellers being kind of smaller organizations selling into these larger organizations. Active buyers and sellers in Class A, right, and top sellers, you can kind of see that, as well as Class B and Class C. Again, very much kind of the same story of buyers and sellers, private individuals, getting out and selling to larger organizations. Also, a lot of new builds being bought. But again, you can see it's hard to get capital out if you're buying new builds. It takes time. It's harder than it is, buying an existing portfolio. So, good news, I would say, is this is another sort of strong signal of the indication of investor interest and values for those who lend, buy, sell. Very attractive investment markets because the operations kind of have been so good. So, Jack, I'm going to stop here for a second, and I've been talking flat out for 35 minutes. Any questions before I move to our sort of traditional discussion on supply? Are there any questions that I can answer from that have come up?
Well, we have a number of questions that are coming up. One of which is whether we have the ability to give them any kind of analysis on boat and RV tracking, similar to self-storage, because many self-storage sites have both.
Well, the detail we do have inside the data tracking of, I'll call it a 10 by 30 or RV storage or boat storage. So that detail from a segmentation basis is available. Same thing on a unit mix basis, looking at 5 by 5s or 10 by 10s or 10 by 20s. In the interest of time, I didn't really present that level of how rents are moving among those different unit mixes. We'll put that into our next webinar, a discussion on are there any divergences to these overall trends when you look inside of it by unit type. But generally speaking, the work I've done in the past is that there is a shortage of RV and boat storage, that it takes a lot of land, so it tends to be quite suburban locations, but they do very well because there's a few places where you can store your RV or your boat. And there has been significant spending in COVID on, I'll call it recreational vehicles of all sorts. So I think it's going to be a very profitable niche if you have enough land to make it work.
There's also a question generally about COVID protocols and how the industry's reacted to that.
Oh, the industry's done an amazing job from an operational standpoint. Amazing job keeping their people safe, staying in business, and quite frankly, there's been a tremendous level of automation and a meaningful movement toward non-staffed locations. So there's a number of organizations that already run their locations without any people at all, fully automated. I expect that will further increase. And I think the industry's done a fine job of being in business, staying in business, being as automated as one can, both on new leasing as well as payments. And by its nature, self-storage doesn't require a tremendous amount of personal contact. And so, if you can automate the payment and you can automate the new leasing transaction, you're on credit card billing month to month. And so, it's a asset class that lends itself toward automation and is consistent with consumer desires, that it's mostly a transaction as opposed to a deeply personal relationship. So I think, again, probably the biggest concern on the expense side is going to be taxes, not so much, people.
Great. Well, let's continue.
Okay, super. So let's dive into something that we traditionally do cover, which is the supply, and just to get a notion of kind of where we ended up, right? So 2020 completions did drop 15%. And you can really see the decline in completions in April and May, a little bit pickup in June, but then July, August were also declines, and so that really kind of accounts for the decline in completions. And we got 114 so far year to date. When you look at abandonments, right, we did see an increase in abandonments in the back half of 2020, and we've seen a relatively speaking elevated level of abandonments in the first 2 months of this year. And so that means sort of a lessening of some supply pressure. And we look at this by market, you can kind of see that a lot of markets that did have a lot of supply were also the ones like, let's say, Boston and Orlando and Texas did see an increase in abandonments, which again, for existing owners is a bit of a positive sign. We did update our supply forecast in the first quarter. It's not quite as pessimistic in terms of the addition of new supply than our July 2020. We're still expecting declines through 2025 compared to pre-COVID. Compared to pre-COVID, deliveries are dropping, kind of about by half over the 5-year period. And there it is a little marginally shifting towards conversions and expansions. But that if you look at graphically, right, our earlier forecast pre-COVID was for a fairly high level of completions, and we're forecasting that really as a decline. What's really driving this, in my mind, is that most of the lending on new additions are done by smaller banks, and they have been under less loose lending, capabilities. So they've tightened up the sort of lending for it, which is creating opportunities. And so the amount of new supply added by the sort of non-professionalized sector is the part that's getting hurt. Folks that are in the sort of professionalized component of self-storage, they've got great relationships with their banks, they've got long-term relationships, they've got a great track record, they're able to get financing. But it's the casual small owner that is getting financed from a local small bank where the decline in supply is coming from.
Jeff, one of the questions that comes up out of supply, someone on our in our audience, what's your take on steel pricing at this point? We've had a contract in November for building $400,000, and today it's at $550,000. Will steel continue rising, and should it come to fall to a more reasonable pricing?
This is a component of that shift, as we kind of mentioned, from services to goods. There's been a sudden spike. If you looked at lumber, lumber is way worse. Now, lumber really is an input in multifamily, not in storage. So storage is much more affected by steel in terms of both the structure and the doors. So yes, it's going to have an impact, and yes, at the margin, it may knock out some projects, just as it would in multifamily. Everything that I would kind of tell you is a large part that was keeping steel prices down was scrap metal and the recycling of it, and there's less of that. So I do think that we'll probably see a movement back to more normal pricing. Give it 6 to 9 months. I think these are supply bottleneck issues and labor bottleneck issues in manufacturing. But for the next 6 to 9 months, you'll probably see an elevated level of steel prices.
You bring a very interesting point. All of the materials that are involved in construction are part of our getting things from Canada, China, Malaysia, and consequently, it isn't a single level of change. All of a sudden, we're making nice with Canada. It doesn't mean we're going to get a whole lot more lumber. We're not going to be able to recycle as much in China and get it back as finished steel the way we used to. So it's a fairly complicated issue with whether or not new construction starting up in the next couple of years is going to end up being any easier.
Well, I think in general, it's tied to a series of trade flows, right? And you kind of mentioned it's a global trade flow of all these materials and productive capacity, as well as the ability to import more. Again, we've experienced 40 years of goods deflation because of being tied to international trade flows, where materials and finished goods of all sorts were deflationary, because there's a lot of supply coming in from low cost supply from China and other developing countries. I think that will probably return to where it was. So, okay. So, looking at new supply, there was a question that came in on demand and the generation using internet searches. What I would just definitely tell you is most of what's happening in the self-storage industry as related to demand is really based upon internet searches. Look at Google, look at the Google search engine numbers. This is a consumer product where I would say a good 70% of demand is internet related. There is some drive-by traffic, but it's mostly an internet search engine game. Anyway, so let me continue here. On the new supply pipelines, if you recall, a couple of years ago, Vegas had very high rent growth and almost no new supply. Well, guess what? There's a lot of new supply in Vegas and Phoenix and in Portland. So supply does respond to movement in demand and in storage, relatively quickly. So there are some very healthy supply pipelines coming in some of the major markets that have been magnets for domestic migration. It's also good to see that supply responds in the other way, where Houston and San Antonio and Denver, which had very, very heavy supply pipelines, those are being mitigated. And so there is, the bottom line is capitalism works, the free market works, and developers respond to where pricing for rents and population growth happens. And I think the greater level of transparency through data services such as our own is enabling markets, both lenders and developers, to respond more appropriately to where pricing and demand is. When we look at expansion activity in the major markets, there's still a fair amount of expansions going on, and that's a reasonable amount of square footage. 12 million square feet, under 2 million that's under construction. When we look at conversions, 2020, I wouldn't take too much kind of note of that, but you're running 16 to 18% in terms of conversion activity as a percent of storage completions, and I think that's probably going to hang in there. We look at some of these smaller markets in a very similar fashion. Some markets that have significant rent growth and lots of in-migration, Boise being an example, are getting a lot of supply on a relative basis. So again, this is something we track and are careful about. And it does give us an indication that if you have very strong rent growth, but very high levels of supply coming, that rent growth will kind of tamp down over the next several years. Same thing on expansion activity in tertiary markets, 113. So you've got a lot of, when you look at conversions, expansions, and new builds. Again, all of it. What's interesting in these tertiary markets that the conversions are a higher percentage of total deliveries, which is a good use of overall real estate capacity. So I guess as we kind of close out kind of this whole discussion, I kind of end up kind of where we started. The economy looks to be really strong in 2021. There's some concerns about inflation we do have to watch, and its impact on lending. And I think there's more upside to inflation than deflation. There's more upside to rising interest rates than falling interest rates. If you can get 2-year financing for a transitional asset, you're not going to pay a lot in interest, but if you're going to do locking in long-term rates probably makes a lot of sense here. It's probably bottomed. Clearly, it's bottomed. Demand trends, boosted demand in 2020. We think that will largely hang in for the next couple of years. I would be continued to watch domestic migration. There is a continued movement of populations with this notion of where you can work, that there's a spreading out of talent and population, which is actually a really good thing for the overall economy, into both, I'll call it tech hubs in the South and West, as well as satellite cities of those tech hubs. And we see that in our data as well. You're going to continue to see a lot of acquisition activity, along with, because of rising street rents and pretty good cap rates relative to other asset classes. And so I think, again, I feel pretty good about the sector. I think it's really going to perform well. I think there's some relative caution one should place as some of the pandemic-induced demand will dissipate over time. And that if you look at, as we've mentioned, some markets have a very large supply pipelines that will, as they deliver, kind of weigh on results. One of the great things about storage as an asset class is that is the existing customer rent increases and stickiness of consumers, allowing, once you have a property that's stabilized, to be continued to generate increases in NOI, even if street rents are under pressure. So that's kind of a good outcome. I would like to highlight to everybody that we do have a national multifamily webinar coming up in a few weeks, and welcome to sign up for that. I do have to, thank you, but also the lawyers make me put this up in terms of copyright, as well as disclaimers. Sorry about that. And the appendix is also here in terms of the table of data. So one other thing I would probably want to mention to everybody is that we just deployed inside of our product monthly market summary pages for all of our markets. I think we've deployed 100, and the remaining 33 or 35 will come next month. And it's a good quick summary of what's going on in the storage markets in about 3 or 4 different pages. So a nice addition to the product. And we'd love to show that to you if you have the time and interest. So Jack, let me turn it back over to you to ask me some more questions and see if you can stump me. And Yeah, what's on the
Oh.
mind of our attendees?
A couple of interesting areas, one of which is in stable markets where self-storage is doing relatively well. Generally, is there a way of determining what percentage of increase in the number of units being delivered will start to affect pricing?
Well, and we have seen, that when you have something like a 4 to 5% or higher deliveries as a percent of stock, it does weigh on rent growth. And as that dissipates, then you kind of come back. We've seen that for a couple of cycles. And generally it takes, some of these development cycles may take 2.5 years to deliver, and then it takes 2 to 3 years to stabilize. So we're again, if I look at a market like Boise, where it's got a very large pipeline, but it hasn't delivered yet. It will wait. Probably as you get 5% of stock is where things begin to wait. Now, of course, and this is the appropriate caveat, storage is an intensely local asset class. So you really do need to look at the 3-mile radius in most markets, excluding dense urban areas. Usually it's a 15-minute drive time or 3-mile radius, and that's the relevant, is how much capacity is being delivered in your trade area as opposed to the metro as a whole.
Okay. There was questions about the relationship between buy versus build, and has the arbitrage widened over time?
I mean, the reason that build was so attractive was that in the minds of investors, you could get a much higher return, on building than buying. So that's what drove the development cycles. But it takes time to deploy that capital. And what has, in my mind, changed is the return expectations of the institutional investors when they look at other asset classes and the speed at which they need to deploy that capital. So development continues to be a very attractive way to deploy capital if you have the time, right? If you're looking at returns, development continues to show quite well. But it's mostly you have a new investor class who has a different set of objectives than maximization of returns over time.
One of the concerns we're asking is really more of a clarification when they're asking, are your projections in self-storage demand related to the consumer or to investors? So I think that we need to expand how that works.
Well, I'm talking about both things, right? So when we talk about rents, okay, and the rent growth, we're really talking about consumer demand, and the consumer demand having been elevated in 2020, and then that will slowly dissipate, but could be boosted by a second wave of moves. That's consumer demand, and has translated into street rent growth. Separately, from investor demands for the assets, that has been fueled by it's a residual of the operational performance of self-storage and relative returns across asset classes. So both of those have been positive, and both of those, I think, will continue to perform well. And investor interest in assets for self-storage will reflect the consumer demand. And I think that's, so if I confused anyone, I sure hope I've allayed that potential confusion.
We had a question specifically about New York City's ICAP tax laws, which I haven't been following very much, but the question is really more, is it likely to have an impact on self-storage construction and cause a lot of things to drop out of the pipeline?
It could. And I'll be honest with you, I have to look at the tax laws more specifically. So I probably want to reserve judgment on that one before I kind of go into more detail. But it probably will. But let me get back with Smeeds on that one. Okay. And someone asked me a very good question. It's like, hey, you're gonna add for the market reports. So one of our subscribers went in and took a look at the listing. Yesterday, I went through that myself and said, hey, we're missing the New York markets. It had been originally excluded because they were under 100 locations. I just saw, I asked though that they be added. Those 4 will be, the New York markets will be added, I think, today or tomorrow. They've already been approved and finished. And then there's a couple other scattering of smaller markets that we will add next month. So hopefully that works. One other question that kind of came in here was, do I predict the increased movement to suburbs will reverse? And this, what we're talking about here is sort of the movement of people and really the recovery of the core cities. And this is a topic that ripples through all the asset classes we cover, whether it's multifamily or office or industrial, as well as self-storage. And when it comes to consumer movement, what generally I would say is this: we do expect, core downtown demand for living there, okay, to gradually come back, okay, over the next 2 years. It's not going to come back, and we see it in the multifamily data already. There is a slow recovery underway. We would expect that as that recovery continues to pick up slowly, there'll be some reduction in self-storage demand in those core cities, because a fair amount of that was storing stuff while people moved out on a temporary basis. We do expect some of that to unwind. However, the movement to the suburbs was already underway. It was demographically driven. The movement to the suburbs was accelerated. Maybe 5-6 years worth of moves occurred within 6 to 8 months. I don't think a lot of those go back, honestly. About probably half of which stay. The other half probably will drift slowly back. I am most bullish about suburban areas within major tech hubs in the South and West, because you have both demographic forces as well as cost of living advantages, as well as this movement of being able to work in the central city less often. That will tend to increase demand in suburban areas in core cities, New York, Chicago, San Francisco, LA, as well as the suburbs of tech hubs. So I think the suburban move has some legs to it and will continue to. It had a demographic push anyway. It will be sort of, it will hang in there. And the urban cores, both of the major cities, which took a hit, and even the urban cores of the tech hub cities, which really flatlined versus went negative, those will recover over the next 2 to 3 years.
Very good, Jeff.
Okay. Any other final questions before we wrap it up?
I think we're fine.
Okay. Well, I would like just to thank all of you for joining us today, hanging in there through all of our questions as we try to answer your questions, and tell you that I feel really positive about the storage asset class. We try to be as objective as we can to give you kind of the straight view, and hope that you found that valuable. We're glad to serve the sector and look forward to showing you the data behind what we do. Take care, be well, and look forward to getting together over the next several months, as well as at industry conferences, which I hope to finally be there in person over the summer. Take care, everybody. Be well. Megan, if you could wrap us up, please.
Sure, thanks, Jeff, and thanks everyone for participating in our program today. We hope you enjoyed it and found the information and viewpoints helpful. If you would like to subscribe to any of our free research, please either log on to yardimatrix.com or contact us and we will add you to our distribution. A recording of this broadcast and accompanying slides will be available after the program. A special thanks to Jeff Adler and Jack Kern for their commentary today. I would also like to thank Jeff Muth and Mary Chu for running the web program, and Maddie Harper and Claire Anhalt for their contributions to the content. This has been a production of the Matrix Division of Yardi Systems, Inc., copyright 2021, all rights reserved. This concludes our broadcast. Thank you.